UPL came out with numbers which optically may have Q4 numbers, which optically may have looked below the estimates, but they walked the talk on certain parameters. And I think it's important to get the perspective from the management about what the quarters ahead, what went into Q4, and what the quarters ahead could look like. Remember, as I looked at their investor presentation, on the revenue front, there doesn't seem to be a problem for the year at large. Maybe subdued profitability in Q4, which impacted the EBITDA growth, and thereby has it impacted the debt repayments as well, is a question that I pose to Mike Frank. He's CEO of the global crop protection business at UPL, joins us right now to talk about everything regards to the company. Mike, good having you. Thanks for joining in. By your own standards and the expectations that you would have had, as well as what the company would have spoken about at the end of Q3, when you spoke about better pricing, maybe better EBITDA growth, so on and so forth, Q4 a bit below par?
Yeah, good to be with you today.
Thank you.
So certainly we were very pleased for the first 3 quarters of our year, where we saw very strong pricing improvements and margin expansion. Q4 was definitely an unusual quarter, and it played out differently than we anticipated at the start of the quarter. And I think, it was precipitated by the post-COVID surge in production coming out of China, particularly for post-patent crop protection products. And what we saw happen was, as the prices and the supply out of China went up, ordering at distribution level actually went down because prices started to come down out of China. And so that played out through really the second half of the Q4. So we took a number of actions. Firstly, we continue to compete very aggressively for shelf space. And in every region, with the exception of North America, we saw a nice growth in Q4 from a revenue standpoint. The US was more challenging. I would say the overall spring season was delayed, and so that impacted the product sales to growers, which impacted our ability to resupply distribution channels in the Q4. Now, in addition to that, because we did see what was happening in China, we also took our own decisions to really de-inventory all of our high-priced inventory. We even slowed down and idled some capacity so that we could really manage working capital and make sure that we had the right amount of inventory coming out of year end. And so we're very pleased with the fact that we've ended the year with a really good inventory position. It's the right amount of inventory, and it's well priced to compete going forward. But of course, those other aspects did impact our overall profitability in Q4.
Would the extraneous factors continue to impact Q1 as well? It well could, because China is still on that opening up and new production, etc., coming in, and not as much demand back in China itself, I reckon. So how is Q1 slated to be?
Yeah, so if you look ahead, I mean, the fact right now is the fundamentals of the business are still very strong, especially at the grower level. Grower margins are healthy, and growers are incentivized to produce a strong crop and produce it more sustainably. And that's where UPL is really well positioned to work with them to create those outcomes. So I would say in our post-patent segment, which is about 70% of our overall sales, that specific segment is going to continue to see price pressure due to the excess supply that's coming out of China right now. Our differentiated and sustainable segment, however, should perform extremely well. Not only will that segment continue to grow in FY24, we would also expect margin expansion, because overall our cost of goods will be lower this year than last year, and largely within that segment, pricing is very stable at the customer level.
Would this be back-ended or maybe starting from the Q2, or would you start seeing this improvement starting Q1 itself?
Yeah, so look, I think in FY24, it's going to be mostly a story of volume for us. And so we're going to start right out of the gate in Q1 with really driving hard on volumes, running our plants, making sure that we have a low-cost inventory position. But we would expect from a pricing standpoint that the pricing headwinds will persist at least through the first half of the year. So I would say in the Q1, it'll be somewhat muted versus last year, especially from a price and margin standpoint, but it should start to recover as the year plays out within the global crop protection business.
Mike, the other aspect is just the level of uncertainty into areas like Europe, which Q3 as well. I didn't have a chance to look at what Q4 Europe has done, but Q3 too was impacted. And and understandably so, because that was the case with most businesses. How easy or how difficult is it, actually, let me rephrase my question, how difficult is it to kind of try and second guess what could happen in that geography uh, into any quarter or the year at large?
Yeah, so there's a few things at play in Europe. Firstly, we have a very strong portfolio of sustainable products. We're by far one of the leading companies selling sustainable products into that marketplace, and the demand for those products is going up every year. And so that part of our portfolio, we see long-term strength in Europe. I would say on the conventional products, we continue to see impacts from product banning in Europe as they move and implement their Green New Deal. And also last year, it was probably somewhat unusual that the currency, the euro, fluctuated quite significantly, at least relative to the US dollar. And so we also saw that impact play out. Now in fourth quarter, we actually saw nice growth in our European business. And so we're optimistic as we go into this next year that we should be able to grow in every one of our regions. I would say the region that probably has the most challenges in the near term is going to be North America.
Okay, and as I look at your investor presentation as well, you're talking about the new blockbuster launches in FY23, which might help you continue momentum in FY24. Is there a formal guidance that you guys are giving about what you might do in FY24 on all key counts, be it the revenue front? I heard you talk about the margins. I'm trying to talk about revenue front / volumes, and also on the debt side, because you've kind of walked the talk there. There were some anomalies relative to what you might have expected, and as a result of which the debt reduction may not have been as much. But still, are you giving guidance for FY24 on any of these counts?
Yes, we are guiding now on FY24 in the global crop protection business. And for UPL Limited, we expect to be up in the mid to high single digit range. So that's our guidance for FY24 for global crop protection. We expect at the midpoint to be up about 6% in the range of 4 to 8%. So we do expect growth. Now, again, that growth is going to come primarily or probably exclusively from volume growth as the year plays out.
Anything on the debt front?
Yeah, so we're very pleased. We had a commitment this year to generate strong cash from operations, and we were able to do that despite the challenging fourth quarter. So we're very pleased as the year played out. We were able to reduce gross debt by over $600 million and net debt by about $440 million. In FY24, we would expect again to generate strong operating cash flow. At this point in time, we're not going to guide on any net debt reduction. We're quite comfortable with our current leverage, but as we generate excess cash, we'll then make the best decisions on behalf of the shareholders to decide how best to invest that cash, whether it's in further debt reduction or in other opportunities.
Mike, relative to what's happening in the world, the numbers that you've spoken about are growth numbers, yes. Just trying to understand relative to the past of UPL, right, pre-COVID as well, do you reckon these growth numbers have a possibility of improving if certain factors were to play out in FY24 itself, part one? And what would those factors be? That's my last question. And of course, part two of my question is, are you guys looking beyond FY24, or is it difficult to do that considering the variables at play in the world currently for businesses are changing almost every single quarter?
Yeah. So last year at this time, we guided on a 5-year plan through FY27 to grow our business top line at a CAGR of 7 to 10%. Obviously, we saw faster growth this year. We believe that 7 to 10% growth over that 5-year period is still very much intact. FY23 saw stronger than trendline growth. FY24 is going to be a little bit more subdued, but it'll be a growth year nonetheless for us based on our guidance. And looking beyond, again, we see a lot of opportunities. You talked about new product introductions. We generated over $140 million of revenue from new products that we introduced last year in our global crop protection business. We believe based on the new product launches that we're bringing this year, we'll generate over $120 million of new product revenue from these new products. And so we have a very strong pipeline of new products and technologies. And most importantly, close to 80% of the new products that we're introducing in our pipeline are in that differentiated and sustainable products category. So today, as I said earlier, about 70% of what we're selling is post-patent and 30% is differentiated and sustainable. As we look ahead to FY27, we believe that our mix will be roughly 50-50 based on our product pipeline when we get to FY27.
Great. Mike, Frank, appreciate you taking the time out and speaking to us today. All the best for the year ahead, and well, may the numbers look on improving as business hopefully improves in the year to come.
Thank you. Good to be with you today.
Likewise. And viewers, thanks for tuning in.